Hi, Cokie here with Wink. What investors need to know now. You know what we're talking about. We're continuing to talk about the best investment advice you've ever gotten. So welcome to Shea Casa. This is the home office. And if you joined me this morning at 5:30 live, this is where you get me. You just usually don't get me with makeup and fancy clothes on. So thanks for joining us here. I'm going to do some dual screening because this is the last episode of best investment advice ever. And so I really felt like I wanted to bring everything back together. We've talked about sell in May and go away. And does that make sense? We've talked about BO, and not all BO is bad. So doing a selective screening of stocks, of those stocks that are buy signals, and also in the column of X's or O's. So making sure you're not purchasing stocks that are a sell signal. You can have good companies that it might not be the right time to buy a good company. It also could be the wrong time to buy a good company. It could be the right time to buy a bad company. So I know that all of that is a lot. I think to sum up the BO and the buy in the column of X's or the BX conversation is one of making sure you have a screening tool and or an advisor that can help you with that. That being said, I want to talk today about a few things. Let's weave in BBS, my favorite term that I heard last week on, I think it was CNBC, BBS, boring but sexy. But you know what? I'm not just going to keep it there. I'm not just going to leave it there. We're going to do BBS. We're going to do boring but sexy. But then I'm also going to absolutely put my neck on the line and give you some sexy. I don't portend or hold myself out there to be an amazing stock picker per se. That's not how I do my best work for my clients and their portfolios. We do own individual securities in our clients' portfolios, but having the next best Tesla is not our strong suit. It's not what we do. That being said, I am going to give you some good stock picks today. So that's the sexy. The BBS is going through some of the feedback I've been getting from others relative to best investment advice. So I'm going to just go quickly through this article was titled 5 Pieces of Investment Advice for Real People. So I think we're real. So here it goes. Number 1, take advantage of employer matching. That is a very, very good piece of investment advice, because if your employer matches 3% of your 3%, you just made 100% on your investment. So it's really good investment advice. So make sure you're doing it. The sooner you start, the better. So we touched on that last week in our sell in May and go away episode, which means you come back in November. So get invested soon. Don't be stuck, and don't stay stuck just because you think the market's doing really well. Create a financial plan, number 3. Absolutely agree with that. Don't try and predict the market. That's a good one. That just really, again, speaks to a little bit of how we talked out of both sides of our mouths with sell in May and go away. And now it's November, so get back in. We don't really believe in sell in May and go away. But if you're stuck in deciding when is the best seasonal time to invest your hard-earned investments or hard-earned savings, typically seasonality, November to April are good months for you. And number 5, and I have talked about this a good bit, but take the long view, expand your view. Like, let's don't think about, oh gosh, I invested in November and my portfolio is down as of January. You need to be thinking more on a 5 and 10 year basis. So that's the boring but sexy. And the boring but not so sexy. There was a few others that we got feedback on that I wanted to share with you. Just some topics here and some sound bites. So if you want to hit on my consult button, I take 20 free consults a week. I'm happy to delve in deeper on any of these topics, but one was dollar cost averaging. I'm trying to think. I got to switch. I'm doing dual screens here. Sorry for that. Also, let's see what else we got. Preserve principal and manage risk. Now, that is super boring and sexy. Preserving principal and managing risk. If you just never lose money and gain moderate returns, this person responded, you will accumulate over time. And they actually said, not sexy, but you do end up with assets to allocate and can punch for bigger wins and while minimizing risk. And I do agree. Further, some of the other feedback I've been getting from others, invest in yourself. I absolutely agree with that, but I just don't necessarily believe that it's in keeping with the spirit of what we were shooting for this month in terms of the best investment advice. So that being said, we gave you the boring. I also want to give you the sexy, and I also want to end with something that was really special that happened at church this Sunday. So it's a little bit of a legacy investment advice, if you can imagine. So the sexy is this, we talked about inflation, and we've talked about, our market's high, and some people are doing this flight to quality because they're worried about valuations and are they buying at the wrong time? And I say this, if that's your worry, and I don't think it's necessarily unwarranted, I do think this market has a ways to go. But if that's your worry and you have that type of feeling, then I would tell you, go back to the B and X's and B and O's. So make sure you're looking at stocks that are buys in a column of X's or buys in a column of O's. Make sure they're good quality stocks and good outperforming sectors right now with inflationary environments. We kind of touched on this last week. You should be focusing on financials would be an area I would tell you to be looking at. Small banks are doing very, very well. And I think tech is going to continue to do well. I want to put a wrapper on all of that and say this. Look for some that have a higher dividend. Look for some of these tech stocks and these momentum stocks that have performed well, but look for those that have high cash on their balance sheets as well as are paying high dividends. Those stocks typically are going to insulate better in somewhat of a downturn. And by the way, they'll be paying you dividends along the way. So I want to share my screen. And since I'm dual zooming and everything else, it might not go over so well. So I want to do this real quickly. And I want to share my screen with you because I did do a screener. So I want to show you some of those buys in a column of X's like we discussed. And you can see what some of those stocks look like. I mean, there's a long list here, and I've ranked, this is my lowest yield. Okay. And so these are some of the growthier names with the lower yield. So 0.8, you'll see over here in the far right column, a 0.82% dividend yield is about that of the S&P 500, a little bit lower. You're going to see names in these green sectors that I would prefer. You'll see here equity bank shares, EQBK with a 0.91% yield. You'll see WSFS Financial at almost 1% yield. What are some of the other names I like? I really like KLA Tencor. So semiconductors in the tech space, those stocks that have decent dividends or stocks that you should buy and hold and should be happy with for some time. So KLAC is the symbol there. You've got another semiconductor, NXPI. I'm not too familiar with that. And, I want to say this, as I'm just rattling off some of these symbols to you, the point is not necessarily that I'm a stock picker, that you should put all your money in these stocks, because some of these stocks are stocks that I own, but some of them are not. The point is that you should have an advisor that you can take a screen to that suits your risk and your suitability. To that investor's comment about the best investment advice they ever got, and was to manage risk, to preserve your capital and manage risk. You just need to dial in what's your risk spectrum. We've talked about this in the past in terms of your buckets. And if you have more than a 5 to 7 year time horizon, then you should be willing to accept some risk, because that should pay off. You should have a double on your portfolio within 10 years is the approximate rule of thumb there. So as I continue through some of these, again, I continue to see semiconductors that I like, with yields of almost 1.5%. There's Qualcomm listed here, Barclays Bank, BCS. So again, inflationary, I would stick with banks. I would stick with those stocks that you know and love, and that rank highly from a fundamental standpoint. How do you know this? Your advisor can run a screen, or I'm sure you can. However, my little tidbit for you today is just look at yield, look at dividend yield, in terms of focusing on the stocks that might perhaps do better within an inflationary environment. So we gave you the boring but sexy, which is dollar cost averaging, and which is preserve capital and manage risk, and which was also, think for the long term and have a financial plan. And now I've given you the sexy. I've given you some names like a Qualcomm and a Barclays and a KLA-Tencor. That's your sexy. Now I want to round out the best investment advice with this. The pastor at church on Sunday said that when he had nothing, he had $2,300 in savings to his name. He made a really good investment in being able to buy a home with no equity down or no down payment. And he flipped that home and he made $50,000. And he went on to tell the congregation that 33 years later, he, which is today, he invested that $30,000 in his congregation. So he invested it in his church and in his parish and in the foundation, of the church. And what he went on to say is, he could have aspired for a shiny bauble, or my words, or a car, or what was one of the other examples he used? Well, the car was a good example because, he said 33 years today, what would that car be worth? It'd be worth nothing. His other example was a boat. Could I have bought a boat? Yes. Well, that boat would be worth nothing 33 years later today, either with the truck. But he said that investment was a legacy investment, and it was an investment that has gone on to bring impact to his family, and to many, many, many others alongside him and behind him, that has forever changed them and will always be there. So that type of legacy investment is investing 4.0, right? And so Greg, the pastor back 33 years ago, wasn't in investing 4.0. He was at spiritual high frequency living 4.0, right? That being said, some of us probably have more in our investment portfolios than we think is enough, meaning I come across a lot of investors who feel like they don't have enough. They don't have enough to retire. I ask you, is it true? And then I would urge you to consider, is there enough in your portfolio or in your checkbook to make a legacy investment somewhere? So I think that might be the best advice. So a little boring but sexy, a little sexy, rounded out with a little bit of legacy from the pulpit. So with that, thank you for joining me here for this week's edition of What Investors Need to Know Now. I hope this has been helpful. Grab your consults at alphavest.com. On the resources page, you can grab a 15-minute free consult with me. I take 20 per week. You need to download Liberated Investor, because here's the sound splash. And here's another good investment tip, is that between now and the end of the year, for those who download Liberated Investor, we will extend $20 flat fee. I always have trouble with that, flat fee pricing for you, $20 a month. Investors are befuddled by, they don't know what they pay. They don't understand their fees. If you're them and you find yourself stuck, get unstuck, download Liberated Investor, and let's chat about a $20 a month flat fee account. Thanks for joining me. I look forward to seeing you next week. We hope you'll join me for 411 Live, 5:30, Facebook every Monday morning. It's where we also talk about wink, what investors need to know now. Thanks.